Hey everyone, welcome to your new unit on accounting for a merchandising business. I typically don't do a video where I walk you through some notes because I know that you can read. However, I am going to take you through just a couple of key slides here to highlight the differences between the accounting you've been doing for a service business and one for a merchandising business. So I'm just going to click on the slides that I want you to look at or to understand better, and then I'm going to look at a summary of our accounts as well so you understand. So the big difference between a merchandising business and a service business is we are selling stuff. And because we're selling stuff, we obviously have to buy inventory and pay for that inventory. So this slide here walks you through some new sections. The orange sections in particular are new. So as per usual, you're going to make revenue and sales. But now we also have something called a cost of goods sold, which is the amount that we paid to buy our inventory. So if I'm selling a laptop, say a MacBook, maybe the retailer buys the MacBook for $1,200 from Apple, and then they turn around and they sell it for $2,000. In that case, our sale would be $2,000, and our cost of goods sold would be the $1,200 we paid Apple for that. The difference is the gross profit, or how much I made on that particular item. So if I sold it for $2,000 and I bought it for $1,200, it means I had a gross profit of $800. And then from there, I take away my advertising expense, supplies expense, all of those expenses, which are called operating expenses, to come up with my net income or net loss. So for now, you're just going to have a cost of goods sold account. As we get further into this unit, you're going to see a different way that we're going to calculate cost of goods sold. But for now, let's not worry about that. And I want to get down into some transactions now. So obviously, if we're going to buy inventory, we have to purchase that from someone. So I'm just going to click to this slide here, which is slide 6 on your notes. But when we buy inventory using a perpetual method, which is this unit, and a perpetual method means we are constantly updating our inventory, just like the term perpetual would mean we are always in motion. So in this case here, a company bought merchandise for $3,800 on an accounts payable. So we have a new balance sheet account called merchandise inventory. It will be the most active account we have next to our cash account. So we're going to debit that just like we do our regular assets, and then we are going to credit accounts payable. If we paid cash for our inventory, then we would just credit cash. So that's going to be a new journal entry that you are going to see quite a bit of, and that is when we purchase merchandise inventory using a perpetual method. Now, if we have to pay shipping costs, I won't go through these slides, but let's assume we have to pay shipping costs on the goods that we bought. We are just going to include them in the merchandise inventory account. So in this case here, we paid $150 cash to pay for shipping on inventory that we brought into our company. So we're going to debit merchandise inventory $150 and credit our cash $150. So far, those are the two transactions that you will see. And then if there's something defective and we need to return it, what we will do is we will just reverse the entry of whatever we're returning. So in this case here, we don't owe $300 in an accounts payable because we have returned those goods back to our supplier. And in return, we don't have that $300 in merchandise inventory, so it will be a debit to accounts payable as it's a liability, so it's a minus plus account, and then we will credit our merchandise inventory. In an upcoming example, you're going to see some discounts. If we have a discount in our purchases, we just take that discount off the bat. So let's say we bought it for $1,000, but we get a 10% discount. We're going to put merchandise inventory at $900, not at $1,000, to reflect the fact that we got that discount. Okay, so let's look at some sales transactions. So when we sell goods to our customers, we know that we are going to get cash or an accounts receivable, and we made a sale. We've always done that with the service business, but there's going to be a secondary transaction as well. And that secondary transaction is going to show us how much that merchandise cost us. So take a moment to look at this slide. You may have to pause the video and rewind and watch a couple of times to see what's going on here, but I will explain it. So on May the 4th, we sold something to our customer on account for $3,800. So we had a sale of $3,800. So we record the sale by saying it's an accounts receivable because they're going to pay us later. The only difference is it might be cash if they paid us up front. And then we made a sale, so we're going to credit our sales $3,800. Again, that's nothing different than what we've done all semester, so this should not be a surprise to you. However, we do have to have a secondary transaction as well. Because we are using a perpetual system, we have to update our inventory off the bat. So what we are going to do is we're going to create a new account called cost of goods sold. That's an income statement account. And in this case, it cost us $2,400 to buy that inventory. So we're going to debit cost of goods sold, $2,400, and then we are going to credit our merchandise inventory, $2,400. The reason we need to credit merchandise inventory is we no longer have that in our system, and it's an asset, which is a plus minus account. So we are going to credit merchandise inventory when we make a sale. So there are two entries now when we are doing a sale using a perpetual inventory system. So pay close attention when you're doing your work, because we will introduce a different form of inventory later on. But for now, it's a double entry, one to show the sale and one to show the fact that we have a cost of goods sold and our merchandise is no longer with us. All right, the last one I'm going to show you is if a customer comes in and returns a sale to us. So it's common for us. I think all of us have probably returned some form of clothing, or if we bought sports equipment that didn't work or whatever, we returned it to the store. It's a very common thing that we see happen in a retail business. So if that happens, or when that happens, we have to do a double entry again. So the bottom entry is just going to show that we are putting our merchandise back into our system. So I'll start with the second entry there. You'll see on May 8th, we had merchandise inventory of 140 added back to our store because we were going to try to resell that. So it's part of our inventory. And it wasn't a cost of goods sold because we didn't sell it anymore. So we need to take that 140 away from cost of goods sold. Now above, if you look, there's a new account called sales returns and allowances. That account is called a contra revenue account. So it is a plus minus account, but it is a revenue account and it's tied directly to our sales. The reason that we create this account is so that we can track all the sales returns that we have in our business. So instead of just putting it back to sales and accounts receivable, we want to debit sales returns and allowances, and that account will hold only the times when our customers return stuff to our company. By the way, an allowance is we would just tell the customer to keep the item because maybe it's damaged or we don't want the packaging is ruined or something. So a return is they give it back to us, we take it back, and then we resell it. An allowance is we just tell the customer to hold on to it and not worry about it. So the reason why we do the sales returns and allowances is because from a management perspective, we want to be able to see if there's a trend with any of the goods that we're selling. So let's say we are sporting good company and people continue to return a similar brand of tennis racket or something, maybe there's something wrong with our supplier and we need to look at that particular brand of tennis racket and what's going on with that. Or maybe we've done something with our marketing and sales efforts that misled our customers and they got something that they actually didn't want. Who knows? But it allows us to make much larger business decisions than just simple bookkeeping of returning of merchandise and crediting of sales and things like that. So those are the major transactions you're going to see when we are doing journalizing and transactions for a merchandise business that uses a perpetual system. I've also added a summary of the accounts that you are going to see. So these are all of the transactions you'll see, and you'll see we don't have to put the title in. So we're in this example where you see buying inventory, that's just me writing this would be the transaction. So you can review those as well. There's about a half a dozen different transactions here that summarize what we just talked about in our notes, and you will see that available for you as a tool to use as you're doing your work. All right, reach out if you have any questions, but that's our intro to a merchandising company.